I'm including this brief introduction to what the financial sector wants to do for translating climate risks into future financial risks. And this is a document that provides instructions to participants for an exercise that's supposed to happen under the auspices of the Board of Governors of the Federal Reserve System, called Pilot Climate Scenario Analysis Exercise, so CSA Climate Scenario Analysis. There are timelines we'll see. What does the Federal Reserve actually do? It conducts the nation's monetary policy, promotes the stability of the financial system, and there are details on how it does that, promotes the safety and soundness of individual financial institutions, fosters payment and settlement system safety and efficiency, and finally promotes consumer protection and community development. And again, there are sentences on how it does that. The Federal Reserve Board promotes a safe, sound, and efficient banking system that supports the U.S. economy through its supervision and regulation of banking organizations. As a part of its supervision efforts, the board is conducting a pilot climate scenario analysis. So this is the first one. This exercise has two primary objectives. The first one is to learn about large banking organizations' climate risk management practices and challenges. So they themselves want to be educated about how large banking organizations are considering the future of climate risk and its management and challenges they expect to face. And secondly, enhance the ability of both large banking organizations and supervisors to identify, measure, monitor, and manage climate-related financial risks. So the idea is that the IPCC has organized itself across the globe to produce these future scenarios under various climate scenarios, which include population, energy choices, infrastructure choices, bioenergy, those sorts of things, policies, etc., adaptation, mitigation. And how do they translate to financial risks when you look at the climate change under those scenarios? That's the main idea. So the climate risk drivers manifest as prudential risks. Here are some examples which are just indicative and not exhaustive. Prudential is basically looking forward, and that is especially for the business. So prudential risks are financial risks and business risks for the future. Climate risk drivers could bring about microprudential risks to supervised financial institutions. These risks may manifest through a variety of transmission channels. So the risk drivers from the climate side include physical risks that are acute and physical risks that are chronic, and then there are transition risks. So the acute ones include hurricanes, droughts, floods, and wildfires, for example. Not exhaustive. Chronic risks, physical risks from climate include higher temperatures, sea level rise, environmental degradations, which are creeping slow changes in the background, and they might cross a threshold and become massive financial risks, in addition to, of course, tipping points in the climate system itself, like catastrophic changes in biodiversity, monsoon system, and so on and so forth. The transition risks include climate policy, technology, regulation, market sentiment, and consumer preferences, and how they interact with the climate change. For example, everything we do affects the climate, carbon footprint, and such. And if we continue to eat a lot of meat, drive fossil fuel internal combustion engines, rely on fossil fuel energy for everything, then how do you bring about top-down regulations and bottom-up pressures or incentives to change behavior and consumer preferences? So the transmission channels then from the climate risk drivers to micro channels and micro channels include non-financial corporates, so profitability balance sheets, and households like income and spending. And the macro channels are, of course, economic and financial and socio-economic. So they include government policy, capital investment, and labor productivity, connectivity, etc., and socioeconomic ones. Already we talk about climate displacement, so population migrations, changes in consumption patterns, resulting in microprudential risks to the credit market, operational and liquidity sectors within the prudential sector. So higher probability of default, loss given default, and collateral values under credit risk. Market risks include repricing of financial instruments and fire sales. Operational risk comes from business disruptions, legal and liability risks, and liquidity risks contain high quality liquid assets demand and refinancing risk. High quality liquid asset demand and refinancing risk. Obviously these are financial jargon that I'm not going to get into, but as a climate scientist I just have to translate as much as possible to the students of climate science. So if you want to go in this direction of thinking of climate change as a risk and the risk translation into financial sector, then you need to follow up on the details. So the protocol includes various modules. Obviously when you want to do some projections for the future of the risks, you are going to use models. So there are a couple of models mentioned here which are going to be used, and there are timelines and protocols set for how to do those. For example, the physical risk module. Physical risks refer to the harm to people and property arising from acute climate-related disaster events such as hurricanes, wildfires, floods, heat waves, and droughts, and chronic shifts in climate, including higher average temperatures which will affect crop yields, health, hurricanes, sea level, of course, changes in precipitation patterns, and ocean acidification, for example, where corals get harmed, other shellfish will get harmed. The pace and severity of climate change is driven primarily by the world's cumulative greenhouse gas emissions. So since the industrial revolution started, how many gigatons we have already put into the system, because CO2 is a long-lasting inert gas. So once you put it into the air, it lasts for centuries, and the warming actually depends on how much has accumulated compared to the baseline. So if we have warmed by about 1.2, 1.3 degrees by now since industrial revolution, that corresponds to how much CO2 has accumulated since then. As described in figure 1, which is this one, physical risks can drive traditional prudential risks for large banking organizations. For example, an increase in the frequency or severity of extreme weather events could increase borrowers' financial stress and reduce their ability to repay or service debt, so repay the loans, etc. Similarly, an increase in the frequency of or severity of extreme weather events could reduce a banking organization's ability to fully recover the value of a loan in the event of default. So that's the physical risk module. Similarly, there's a transition risk module. I won't read the details, but transition risks refer to stresses to certain institutions or sectors arising from the shifts in policy, consumer and business sentiment, or technologies associated with the changes that would be a part of the transition to lower carbon economy. So socio-technical transitions of the energy system, the transportation system, etc., are going to affect the financial sector. So those are called the transition risk module components. So these changes can lead to traditional prudential risks for large banking organizations. For example, changes in consumer sentiment or policy could impact a corporate borrower's production, sales, and profitability as demand shifts or costs change. Okay. The summary of design elements for the scenario modeling. Tables 1 and 2 summarize key design elements of the physical risk and transition risk modules to translate to prudential risks for the future. So they include things here, general design elements of the pilot climate scenario analysis exercise. So element and description. So there are risk drivers, so physical risks and transition risks modeled independently in separate modules. Estimation, so participants estimate loan level results for select credit portfolios. Balance sheet assumptions remain static. Key risk parameters include probability of default, loss given default. Bank submissions include data templates supporting documentation and responses to qualitative questions, and the date is as of December 31, 2022 for feeding into this module. Module-specific elements of the pilot climate scenario analysis includes scenarios, type of shock, projection horizon, loan portfolios, and potential mitigants. What we will do to alleviate the risks or these elements. So the physical risk module again will include a range of severity of shocks, common hazard specified by the Federal Reserve, idiosyncratic hazard, we will see what this means, and the horizon is going to be 1 year out to 2023. Residential loan portfolios include residential real estate and commercial real estate, and mitigations will use insurance tools which are already in place. So insurance, reinsurance industries themselves are having to deal with climate change and the associated risks, like if you funded a development activity in a coastal region, then you have to worry about how cyclones are going to change, how storm surge inundation is going to change, etc. The transition risk module then from the network for greening the financial system, current policies and net zero out to 2050. Projection horizon here remains for the transition risk module 10 years out to 2023 and 2032. Loan portfolios for the transition risk module include corporate and commercial real estate. Potential mitigants for transition risk module include obligor transition capacity. So you have to look up what that means. Common shock, some examples. The common shock component of the physical risk module considers, there's a lot of birds screaming outside my window here, but hopefully it's mostly enjoyable. This considers participants' vulnerability to severe hurricane or series of hurricanes resulting in both storm surge and precipitation-induced flooding in the northeast region of the United States as defined by the 4th National Climate Assessment. So there is the global assessment under the IPCC, and US takes that and does the national climate assessment, which is done almost every year. You can look it up, and that provides region-specific climate change impacts in terms of temperature, precipitation extremes, agricultural impacts, sea level rise, etc. So if you look at composition of National Climate Assessment regions in NCA4, it has Northeast, Southeast, Caribbean, Midwest, Northern Great Plains, Southern Great Plains, Northwest, Southwest, Alaska, Hawaii, and Pacific Islands, and they include all these states in it. So the protocol here specifies something specific, like with climate change, will the Northeast region face more severe hurricanes or fewer hurricanes but more of them being severe, and so on. So there are various changes. In general, to map to the climate and socioeconomic scenarios used by the IPCC for its assessment, the assessment report 6 came out in 2021-22, delayed a little by the pandemic. So you look at the radiative forcing level in 2100 in watts per meter squared, which means increased greenhouse gases are trapping more and more energy, which ends up being more of the energy being trapped when you compare the solar energy coming in and the thermal energy going out. So the previous assessment used this called representative concentration pathways, or RCPs, where RCP 2.6 used pathway of carbon emissions and greenhouse gas emissions, including methane, N2O, etc., which resulted by 2100 imbalance of 2.6 watts per meter squared, which according to models gives us a warming of less than 2 degrees C by 2100 with the probability of something like 67%. Then you had middle of the road representative concentration pathway with 4.1 5 watts per meter squared, and you had something called business as usual, where you basically didn't do much and ended up with the worst case scenario of something like 8.5 watts per meter squared additional forcing by 2100, which would give you warming of 5 to 6 degrees centigrade or higher when you include the uncertainties of the models in projecting and so on. In the next assessment that came out, assessment report 6 or CMIP 6, they created these new pathways called shared socioeconomic pathways, which added, in addition to the emissions, they added considerations of sustainability, which also was middle of the road scenario, regional rivalry in the socioeconomic pathways, inequality was allowed to grow in SSP 4 scenario, and SSP 5 scenario is again business as usual, where fossil fuel development was going full speed, so we are not worrying much about adaptation, mitigation, global warming targets, and so on. So you can look at the radiative forcing here again, and they are mapping onto shared socioeconomic pathways and RCP to call them as SSP1 2.6 and SSP1 1.9. So SSP1 is the sustainability pathway and 1.9 is the radiative forcing level by 2100. This is expected to give us warming of less than 1.5 degrees C by 2100 with a 66% probability, and if you go in this direction you end up with SSP 5-8.5. so radiative forcing by 2100 of 8.5 watts per meter squared, and you are using fossil fuel development as a mode of operation. So they were divided into tier 1, so top priority scenarios and additional scenarios of interest, where large number of models, climate models and Earth system models across the globe participate. They all use these and make multiple projections into the future, and the models are put together to produce some kind of a consensus projection for the future. So here for the financial system again, they translate these SSP2 4.5 or RCP 4.5 pathways with a 100-year return period loss. So here climate conditions broadly consistent with these scenarios are used, but they add that impact should be estimated assuming insurance coverage as of December 31 2022, if any. So that's how the financial models will go forward with the climate scenarios. Secondly, climate conditions broadly consistent with the possible future climate conditions in 2050. So this is also 2050, as characterized by SSP 5-8.5 pathways with a 200-year return period loss. So when you have extreme event like a Hurricane Harvey or a tornado season and so on, sometimes they are so severe that they would only happen every 100 years or every 200 years. And the idea is that climate change will load the dice in a way that the once in a 100-year event will begin to happen much more often, maybe every 20 years and so on. So you have to assume return periods and the damages associated with them. And the third one used again SSP 5-8.5 with a 200-year return period loss, assuming no insurance coverage, here assuming insurance coverage as of December 31. So these are basically consensus scenarios converting climate scenarios and climate risks into financial risks using the financial models. So there are chronic risks and idiosyncratic shocks. So for the idiosyncratic shock component, participants should select a hazard event or a series of events and one of the 10 geographic regions, as we saw in from the National Climate Assessment. So that's NCA 4, based on materiality to their business models and exposure. So each bank may have put their money into a specific sector like commercial property or residential property, so they have to choose the appropriate region and scenarios. Participants should select a geographic region other than the Northeast region, which is used in the common shock, idiosyncratic shock and the common shock. Participants should provide a qualitative description of the rationale. Okay, I won't go here again. This is actually repeating itself. I made a mistake there. Summary of physical risk shocks. So each of the scenario from the IPCC is converted into common shock and idiosyncratic shock. Return period loss is prescribed, time horizon is prescribed out to 2050, and the hazards are recommended in terms of impacts and the geographies. So severe hurricanes for the northeast, severe hurricanes for the northeast with existing, so mitigants are included here, existing coverage. So these are different scenarios here. So the climate background will be very different for the same region, for the same category of hazard. And similarly for the business as usual scenario, do it with a 200-year period return loss, and the same here. Again, severe loss but no coverage here. Similarly for idiosyncratic shock, you have return period, horizon, time horizon, hazard is participant chosen because it's sector specific, region specific, and regions chosen have to again be appropriate for the particular financial organization and their asset management. So existing coverage and no coverage. So you just get a sense that they have created a smorgasbord of scenarios with additional hazards picked, handpicked for the banking sector, and they have to then report the risks for the future. Credit estimation methodology, there is a projection horizon and a portfolios in scope. This gets very financial in terms of its jargon, so I'm not going to read it, but if you want, the report is available online. So here the evaluation of physical risk for the pilot climate scenarios analysis exercise will focus on physical hazards occurring in the United States in 2023, the year we are in, a common hazard prescribed by the Federal Reserve, and 2, an idiosyncratic hazard that is selected by each participant. So already this becomes complicated in the sense an El Nino is forecasted for this year, and natural variability like El Nino, which is of course affected by climate change, is going to interact with climate change itself in terms of snowfall and drought, crop yields losses, extreme temperatures, wildfires, and so on and so forth. So projection horizon is out to January 1, 2023 for common and idiosyncratic shocks. So you are starting the year out, and the portfolios in scope include a bunch of things here that I'm not going to go into, so you can look it up. Okay, projection granularity, at what scale should the banks do these projections? Participants will provide loan and facility level projections for select risk parameters as applicable. And in the direct and indirect impacts, given the exploratory nature of this pilot exercise, the review will primarily focus on the direct impact of physical risks on credit risk. So they will not look at cascading indirect impacts. They will just look at physical impact and impact of the physical risk on credit risk. So there are details. There is a balance sheet approach. Projected risk parameters include probability of default, internal risk rating grade, loss given default, and so on. This is again the transition risk module that we looked at, and the final message here is that the Network for Greening the Finance System projected US carbon price is to be used for 2020 to 2035. So in the current policy scenario, the US carbon price remains at a constant value of around $20 US 2010 per ton of CO2 equivalent through the simulation of the economic models. CO2 equivalent is of course something we do by translating non-CO2 greenhouse gases with their global warming potential to CO2 equivalent. For example, methane is 26 times as powerful a greenhouse gas as CO2, and so on. Okay. In the net zero 2050 scenario, the model projects a carbon price path for the US that starts around $120 US pegged to 2010 in terms of tons of CO2 equivalent in 2025. So you can see the time horizon going out to 2035. The current policies will keep you along these green circles here, the gray circles here. But the net zero scenario, of course, requires us to start taking care of the carbon using direct air capture, bioenergy, and various other methodologies, renewable transitions. So obviously the cost of carbon will go up. Here the Network for Greening the Financial System projected US GDP annual growth rate for 2023 to 2032 is given. So there is the time horizon, and here is the percent of GDP with the current policies, how it drops. But if we stick to net zero policy, we pay a heavier price, but in the end we benefit in terms of the co-benefits of doing net zero on GDP. For example, rainfall changes, temperature increases can have net negative effect on the GDP, but protecting ourselves against warming and extreme events, rainfall changes and so on, by heading towards decarbonization and net zero by 2050 will begin to protect the GDPs. Okay, so it's a kind of brief introduction. I tried to keep it as short as possible, but obviously that also means I skipped a lot of details. But if this is of interest, you should follow up, and especially in terms of the integrated assessment models that take the climate risk and then translate them into these physical risks, into transition risks and microprudential risks. Okay, so I'll leave it here for now.